Hello, good evening, everyone. We will be starting in 2-3 minutes, and we are waiting for the more participants to join. Hello, hi, everyone. Uh, am I audible?
Yes, Salman, you're audible.
Okay, thank you so much, everyone, for joining this evening for a wonderful webinar on Zakat and
Salman, your voice is breaking, I guess.
Tax updates with regards to Saudi Arabia. We have just one important message I'll give right away here is to the members of the institute to renew your annual subscriptions as well as and file your annual membership because it's already overdue at the end of the session, along with the video snapshots of all the participants. So over to you, Mr. Ahmed and Danish. Thank you.
Thank you very much, Salman, for organizing this session. Assalamu alaikum, everyone. Thank you for joining today. Let me introduce myself. My name is Ahmed Mubarak. I'm senior principal with Ernst & Young Middle East, based in Jeddah, Saudi Arabia. I have been with the firm since 2007. I'm a chartered accountant with over 24 years experience in the tax and Zakat field, including 11 years in Saudi Arabia, 13 years in Egypt. I am holding a doctoral degree in business administration and master degree in business administration as well. I will stop here and I will hand over to my colleague Danish to introduce himself and to start the session. Over to you, Danish.
Thank you very much, Dr. Ahmed. Assalamu alaikum and good evening, everyone. It's a pleasure to be a part of this session today. I would like to thank Salman for arranging this webinar and to let us be the presenters today. Just to give you a brief overview of myself, a little bit of the background. I am an IFA member and I have been for the last 4 years. I am a UK graduate. In terms of the professional experience, I worked in an accounting firm in the UK for a couple of years before moving to Saudi in 2015. And ever since, I've been a part of EY, EY tax specifically. I have worked in different aspects of the Saudi Arabian tax and zakat matters, starting off with the compliance, and then I moved on to the controversy part. And over the last 3 to 4 years, I have been section of the tax subservice line that we have. It's an honor to be a part of this discussion. And today we will be talking about Saudi Arabian tax and zakat matters, specifically the key updates that have happened over the last few weeks and months, but more in general about the overview of Saudi Arabian tax and zakat. Before we start off the session, there's just a few housekeeping rules that I wanted to draw your attention to. To begin with, my humble request is for all of you to jot down the questions that you have during the session when I will be presenting and as well as when Dr. Ahmed will be presenting. This is just to ensure that we address the questions in the session that is specifically designed for that. So we're going to have the presentation where I will go through the first half of the presentation slides, and then the remaining will be dealt with by Dr. Ahmed. At the end of the presentation, we have a Q&A session, and that is where we'll be taking the questions and then responding to them on a first-in person. So without delaying this any further, let's start off the session. These are the topics that we will be covering today. The brief overview of Saudi Arabian tax and zakat. We'll also be talking about tax and zakat profile and the different ownership structures. What are the components of the zakat base, the way the zakat base is computed, the different elements of the zakat base is, how they're treated in terms of the zakat calculation, some of the key considerations of the zakat regulations under then we talk about the appeal process, the different sort of methods available under the regulations to resolve your tax and zakat controversy. Then we talk about the recent updates in terms of the ZATCA leasing practices, ZATCA collection rules for investment funds, as well as the endowment funds. So these are all the topics that we're going to be talking about. Just to kind of give you a bit of a heads up on this, we're going to be focused more on zakat rather than corporate income tax. The reason for that is quite simple because we do not have the luxury of time. We have a set 90 minutes that we have to cover all of these topics. Unfortunately, if we had brought in corporate income tax as well, then that would be quite a bit for you to one, take in the session, and two, for us to present as well. Because tax and, the corporate income tax in itself comprises of the CIT, and then you have the withholding tax, and it's quite complex. So we're going to be sticking more towards zakat in this session. And perhaps maybe if we have a possibility of having another session at some other time, then maybe we can have that focus on the corporate tax and withholding tax as well. Right. To begin with, this is what you see on the screen is a brief overview of the Saudi Arabian tax and zakat regulations, the way the profiling is done in terms of the zakat and corporate income tax. You see on the screen who is liable to tax and zakat. Now, Saudi Arabia has two forms of direct taxation. One is the income tax stream, and then the other one is the zakat. Both of them, there are certain criteria that determines which category you fall under. In terms of resident capital companies, it is the shareholding of the company that determines the way they're going to be treated in terms of the corporate income tax and or zakat. Wholly on non-GCC companies, including the branches and the tax permanent establishment of non-residents, fall under the category of corporate income tax in Saudi Arabia. Whereas wholly owned Saudi or GCC owned companies are subject to zakat in Saudi Arabia. One important distinction to make which is actually common in both companies subject to CIT as well as zakat is the withholding tax element when it comes to distribution of dividends. Withholding tax is a tax paid on behalf of non-residents. Payments of dividends made to non-residents are subject to withholding tax at 5% under the domestic regulations. This requirement is common between both entities that are subject to CIT as well as the ones that are subject to zakat. So you may be subject to zakat as a resident of Saudi Arabia or as a GCC national. But if for zakat purposes you are not considered as a resident inside Saudi Arabia, in that case, any dividends that are paid to the shareholders will be subject to withholding tax at 5%. It gets a little bit more complicated in terms of entities that have a mixed ownership. So, in case there are entities that have a different shareholding or mixed shareholding, for example, they have a set percentage of the Saudi shareholding or GCC shareholding, and then they have the non-resident Saudi shareholding. These entities are classified under the category that is called. We talk about the mixed entities. The shares of the entity that are attributable to the Saudi shareholders or the GCC owners are subject to zakat in Saudi Arabia, whereas the remaining shares that are owned by the non-GCC, non-Saudi are subject to corporate income tax at 20%. Again, the requirement of the withholding tax still kicks in for the non-residents when payments are being made to non-residents on account of dividends. These dividends are subject to withholding tax at 5%. The other tax that I will briefly touch on and not go into a lot of is the withholding tax. Withholding tax is a tax that is levied on non-residents that are generating income from Saudi Arabia on account of the Saudi source income. So there are different kinds of payments, there are different kinds of income when it comes to the Saudi source income. You would have the primary example of that is the dividends that I just explained briefly just a few minutes ago. You would also have payments on account of services, you would have royalties, interests, All of these payments are subject to withholding tax, and there are different withholding tax rates applicable for each of these types of payments, on account of royalties, interest, services, dividends, etc. Then we have the third, which is the individuals. Fortunately for us in Saudi Arabia at the moment, Saudi nationals or non-Saudis, there is no personal income tax in Saudi Arabia. However, there is a requirement for social security contribution, which are, depending on the nationality that you have, there are certain requirements you have to fulfill, and then there are certain obligations. For the non-Saudis, it's a fairly smaller percentage that is payable. I believe that's 2%. Whereas for the Saudi nationals, it's a far bigger contribution, both by the employee and the employer. So this is just a brief overview of the sort of taxes that we have in Saudi Arabia, as well as zakat. This is generally the rules that govern how the taxability of an organization in Saudi Arabia is governed. In terms of the zakat and tax profile under different ownership structures, you will see three different scenarios on the screen at the moment. Under scenario one, you have a Saudi or a GCC national. And as I explained in the previous slide, this entity will be subject to zakat, as well as withholding tax, which is on the dividend capacity. But in terms of the tax and zakat aspect, you would only subject that entity, the entity that is owned by Saudi or GCC national, to zakat only. Under scenario two, we have an entity which is 100% owned by non-GCC. This entity would only be subject to corporate income tax. Whereas in scenario three, you have a mix. So you have an entity that is 75% owned by Saudi nationals or GCC nationals, whereas the other 25% is owned by non-GCC nationals. In this case, this entity will be considered as a mixed entity and then be subject to tax and zakat based on its respective shares. 75% of the shares that are attributable to Saudi or the GCC nationals will be subject to zakat, whereas the remaining 25% will be subject to corporate income tax in Saudi Arabia. Now we're going to talk about the components of the zakat base and the computation, the way it is done for zakat purposes. There are four major components of zakat base. The first and the foremost is the adjusted profit. Then you have the internal sources of funds and external sources of funds and zakat deduction. Essentially, the way the zakat base is computed is it is the higher of zakat base, which is the sum of the adjusted profit, internal sources of funds, and external sources of funds. I will talk about the internal sources of funds and external sources of funds now, just to give you a brief idea of what elements these comprise of. In terms of the internal sources of funds, you have equity and provisions, for example. And then you have the external sources of funds. These are external. In terms of when we talk about external sources, these are bank loans. These can be credit balances, which are creditors. You would have advances from customers, so on and so forth. Sorry, Ahmad, you've just raised your hand. Did you want to add something?
Yes, please, Danish. I just saw a message from Saifuddin al-Sheikh. He's raising his concern about the voice is not coming proper. So we need to make sure that it's only an individual issue or everyone is seeing the same. The voice, I'm talking about the voice.
Can you hear me clearly?
Yeah, but it's like up and down.
Okay. I'll try to speak up a bit louder, so hopefully it will address the issue.
Thank you so much.
Right. So in terms of the components of the zakat base, as I was just explaining, there are four elements to it. So you have the adjusted profit, you have the internal sources of funds, which comprise of equity and provisions, and then you have the external sources of funds, which are term loans and similar credit balances. You would have provisions. You would have account payables in this. You would have liabilities, which are then added to the zakat base on the they've remained in the business for more than a year. The fourth one is the zakat deductible assets. This is the deduction that you get from your zakat base. Basically, what these assets are the assets that basically allow you to generate zakatable income. These assets in the formula, if you see on the screen under the computation of zakat base, it is A plus B plus C minus D. So essentially what you do is you add your adjusted profit, your internal sources of funds, your external sources of funds, and then you deduct from that your zakat deductible assets. So the number that you arrive at that point is considered as your zakat base. Now, zakat is payable either at the higher of your zakat base or your adjusted profit. So in case, if for example, you have an adjusted, so in case you have an adjusted profit, you have internal sources of funds, you have external sources of funds. Essentially, what you would do is you would look at your equity, you would look at your provisions, you would add what you have to add in terms of your external sources of funds, and then you bring in your zakat deductible assets. The balance of this, if it comes out to be zero or less than that, in case if it is a negative zakat base, in that case, then your zakatable profit becomes your zakat base actually comes down to your adjusted profit. And if you see in the third section on the slide on the screen at the moment, see that the zakat due is the minimum zakat base is equal to the adjusted profit for the year. So there is the minimum zakat threshold that is defined in the zakat regulations under MR 2216, and it clearly states that minimum zakat has to be paid on the adjusted profit. Now it gets a little bit interesting in case when you have an adjusted loss. And in that case, there is no zakat payable because you would have a negative zakat base and you have an adjusted loss. In that case, there is no zakat payable for the year. In terms of the zakat rate, this is as per the Sharia. The zakat rate remains the same. It is 2.5%. It does not change. But what you see on the screen right now is a different rate, which is 2.5776. The way this number is being arrived at is the number of days in a calendar year that you have as per the Gregorian calendar compared to what you have as per the Hijri. Zakat is calculated on the Hijri calendar, which is 354 days. So in case if you have, for example, a year where you have 366 days, you divide the 366 days by 354 days, and then you times it by 2.5%. And that is what then gives you the adjusted zakat rate for the zakat base. Interestingly, what the ZATCA or the zakat regulations prescribe in the rate of the zakat on the adjusted profit remains 2.5%. It does not change to 2.5776. It is only the zakat rate applicable to zakat base that is at 2.5776. And the zakat rate on the adjusted profit will remain as 2.5%. Here we talk about the internal, the external sources, and the deductible. Now, this is something I briefly touched upon in the previous slide. I'm being a little oversensitive, overcautious about my voice. Please confirm to me, Dr. Ahmed, if you can hear me clearly now, and the rest of the participants as well.
Sorry, can you say again?
You can hear me clearly, right?
Yes, I am. Yes, of course. Yes.
Okay, great. Thank you. Right. So in terms of the internal sources, the external sources, and the zakat deductible assets, we'll talk about these in a bit more detail now. The internal sources technically is part of your is all of your equity. So what is being reported in the equity is considered as your internal source. In addition to that, what you have is the statutory and other reserves and the provisions. Now, you would probably think, why are the provisions being added? Now, provisions, even though provisions are basically hypothetical numbers that we put aside as funds to be used in the future against a liability that you see forthcoming in the future, right? Even though you, from an accounting perspective, you would expense them out, from a zakat perspective, these funds have remained in the business and have not gone out until they have been utilized. So if you see here, what we say is the provisions, the opening balance, less the amount utilized or paid during the year. So essentially what the principle behind this is the funds that have really stayed in the business for more than 2 years. So for the provisions, you would take the opening balance and then you would deduct from it from the amount that has been utilized during the year. That number is then added to the zakat base under the internal sources of funds. Then you have the partner current account. If it has been classified as part of the equity, then that partner current account is also considered as an internal source. Interesting part in that is the retained earnings. If you see the second bullet there, opening balances of retained earnings net of dividends paid. So the retained earnings, if you have any at the beginning of the year, and then that balance, if you continue to have until the end of the year, is then considered to be, the balance that has remained in the business for 12 months. What is allowed for zakat purposes is a deduction of the dividends that you've paid out of your retained earnings. That would then result in the reduction of the opening balance, and whatever is left over between the opening balance and the retained earnings is then added to the zakat base. So that's your internal source. The external source are all the external elements, all the external sort of financing that you have, the external sort of working capital liabilities that you generate, that you accumulate over the course of the year, are then added as an external source of funds to your zakat base. Examples of them are provided on the screen. You see there are short-term loans, there are long-term loans, credit balances, amounts due to related parties, loans from partners classified as liability. You see there is a difference in the classification of loan. So you see here on the internal sources, you would see the partner current account, which is classified as part of the equity. If it is part of the equity, it goes into your internal sources. But if it is classified as a liability from the partner, then in that case, it will be considered as an external source of funds for zakat purposes. You then have the advances from customers, your deferred revenues, and any other credit balance. These are considered as your external sources of funds for zakat purposes. Deductible assets. Now, zakat deductible assets, this is, by the way, category D that we were looking at in the formula on the previous slide. This is what it talks about. So if you see, there are various examples of zakat deductible assets that you see on the screen. You have the fixed assets, your capital work in progress, tangible assets, spare parts, properties under development. There is a set criteria for the development properties that you have to follow in order for it to become or to be considered as zakat deductible. Otherwise, if it does not fall into the does not meet the criteria, then it would not be considered as a development property for zakat purposes, and as such, you will not be able to claim a deduction of that. Then you have the long-term investments in local and foreign entities. Similar to the development properties, you have there is a set specified requirement for the foreign entity. Well, you need to comply with the regulations in order to be able to then consider the foreign investment as a deduction from your zakat base. Then you have advance payments against fixed assets, deferred charges, and statutory deposit for insurance and reinsurance premium. Just taking a step back and going back to the long-term investments in the foreign entities. Basic requirement of that is these entities, the entity that you can claim a deduction of as an investment from your zakat base, should have settled zakat on its results. Now, in terms of the local entities, it's a fairly straightforward process because these entities are registered with the ZATCA for zakat purposes and they're settling their zakat. And as such, whatever investments you've made in these entities are then considered as zakat deductible assets. Whereas the foreign entities, as you would understand, the element of zakat or the application of zakat is generally not applied in most part of the world, and therefore any investments made in these foreign entities are generally not considered as deductible for zakat purposes, unless these entities then settle zakat on their results, and an auditor certificate is provided confirming that the zakat calculation has been made in accordance with the zakat implementing regulations under. Just to kind of wrap this up in the context of the formula, you will see that these are the three main components of the zakat base. Adjusted profit is just one element of the formula, but then that is when you look at the zakat base calculation, these are the three components you look at in detail before you even look at the adjusted profit. These three elements primarily determine what your zakat base is going to look like. So just as a summary of what we've covered, you have the internal sources, which are the funds that are available in the company as part of its equity. Then you have the external sources, which are external credit balances. So you have your loans, your overdrafts, you have your creditors, due to related parties, and so on and so forth. And then you claim a deduction of the Zakat deductible assets on the basis that these deductible assets have helped the company generate zakatable income. And that is the idea behind having the Zakat deductible, these assets as deductible. So if you see here on the screen at the moment, the treatment of external sources of funds. Now we discussed we discussed the external sources in the previous slide. How are these balances then treated from a zakat perspective? Loans and similar credit balances classified as long-term are subject to, loans and similar balances that have remained in the business for 354 days or more. Zakat is driven on the lunar calendar. That is the lunar calendar, the Hijri calendar, is what the zakat is computed on. The lunar calendar, the Hijri calendar, comprises of 354 days. So any loans or credit balances that have remained in the business for 354 days or more are to be added to the zakat base. Now, it becomes a little bit more interesting when you look at the long-term loans that have a maturity period of 350 days or more and overlaps over 2 years. Now, previously, as a consultant, I can tell you this, there were so many instances where I would have clients coming to me saying, we obtained a loan on the 1st of July, for example. At the end of the year, assuming it was 31st of December, this loan did not stay in the business for more than 354 days, and therefore it should not be added to the zakat base. Now, if you look at it on the face of it, the argument is valid. It has not stayed in the business for 354 days and should not be added to zakat base. What the zakat regulations under MR 2216 have done is it gives you a condition that if this loan overlaps over 2 years, and the duration of the loan is 354 days or more, in that case, it has to be added to the zakat base on a pro rata basis, based on the number of days. So this is an interesting development that has happened since the introduction of MR 2216. So even though if you have obtained a loan on 1st of July, any year, at the end of the year, even if it has not completed 354 days, you would still be required to add it to the zakat base if you know the duration of the loan is going to be spread over 2 years and it is for more than 354 days in terms of its maturity period. The zakat regulations go on to talk about the term loans and further state that the term loans are considered to be continuing with the company if the loans are renewed or rescheduled with the same creditor. So you may have a loan for example, 3 months, but then you have a schedule wherein this loan is then renewed for another 3 months, and then renewed for another 3 months, and then another 3 months. So even though in technically speaking, this loan was only for 3 months, the fact that it has been renewed over and over and over again, it will be considered as a revolving loan. The other criteria it provides is it being replaced by other sources to finance the same item. So for example, if I have a loan, say for example, from SAB Bank, and I have a loan of 50 million from SAB Bank for 6 months. Now, at the end of 6 months, I go on to Bank Al Raji and I get another loan of the same amount, repay the loan to SAB, and then have this loan balance continue in my bank, in my accounts, but with a different lender. Even in that case, that loan will be considered as a continuation of the previous loan. It will not be considered as that loan being paid off and another loan being drawn down. No, it will be considered as a continuation of the previous one. So these are very important considerations to be made when it comes to the treatment of loans, especially in the context of external sources of funds. Then we have the loans and credit balancing used in balances used in financing zakat deductible assets. Now, the zakat regulations are very, very clear in terms of the zakat financing done for zakat deductible assets. Those funds that have been borrowed to finance zakat deductible assets are to be added regardless of the period that the company has them outstanding for. It does not matter. It could even be a day. So imagine if on the 31st of December you draw down a loan for a period of maybe 1 year or say 6 months, right? But this has been used to finance purchase of a zakat deductible asset. In this case, that loan has to be added to the zakat base, the entire amount, not on a pro rata basis. Because the reason for that is very simple. It is the matching concept. So if you're claiming a deduction, let's take it a step back. So for example, if you've obtained a loan for 50 million to purchase a new factory, at the end of the year, and you've obtained the loan on the 31st of December, and hypothetically speaking, on the very same day, you went out and you purchased a factory. For the year ending 31st of December, when you calculate the zakat base, you will naturally claim a deduction of the investment that you've made in the factory. Similarly, the fund that you've used to finance that has to be added because those funds did not belong to you. So it's not as a result of funds going out of the business that you've purchased the factory. It's actually funds coming in and then becoming a liability in your books that will remain in the books, and you have used those loan proceeds to finance the purchase of the zakat deductible asset. So it will be added to the zakat base. Then it talks about deferred revenues and advances from customers being added based on the opening and closing balance, whichever is lower. These are to be added to the zakat base. Now, the very interesting thing about the new zakat regulations is the introduction of Article 43C. And I don't want to make it sound very complicated by referring to articles. Basically, what the Article 43C talks about is the loans and similar credit balances that are added to the zakat base should not exceed the assets that are being deducted from the zakat base. So essentially what it says is there is a cap to the additions that you make in terms of the external sources of funds. And I think, and I hope, this is where you will see the difference between the internal sources of funds and the external sources of funds. So in terms of your internal sources, there is no cap. So your equity, your provisions, they will go into your zakat base irrespective, regardless of what your deductible assets look like. Whereas your external sources of funds are to be capped up to the maximum of the zakat deductible assets. So essentially, in a nutshell, what you would be doing when you're looking at your zakat calculation is you end up paying your zakat at the actual equity owned by the company and not more than that. These are some of the key considerations under zakat regulations that were introduced under the more important and the more usual aspect of the zakat regulations that we see on a day in, day out basis over the last few weeks and months is the introduction of the statute of limitation. Now, historically, the income tax law had this provision ever since it was introduced in 2004. However, this concept was not implemented for zakat purposes, but now we have it. The statute of limitation for zakat purposes is 5 years. So the ZATCA, as per the zakat regulations, can issue an assessment within 5 years from the due date of filing the annual return. What is the due date of filing the annual return? It is 120 days from the financial year end. So for entities, for companies that have the financial year end of, in this case, if we look at the more recent example, 31st December 2023, the zakat return for these entities are due by the 29th of April 2024. The ZATCA has from the 29th of April 2024 up to 5 years to raise an assessment for these years. On the assumption that they did not issue the assessment within 5 years, these assessments will be considered as finalized for zakat purposes, as well as for corporate income tax purposes, because that is the period under the income tax law as well. Now, having said that, the zakat regulations also provide the ZATCA with certain relaxation when it comes to the statute of limitation, and it extends it to 10 years in case of certain non-compliance with the requirements. The requirements, we'll talk about that in a minute, but if you look at the second bullet point, that the ZATCA may rectify an assessment within 10 years from the due date of filing the annual return in case of calculation errors or mispositioning of a figure. This is so important that a zakat payer needs to focus on the information that is being reported in the zakat return. Any calculation error or mispositioning of a figure could extend the statute of limitation from 5 years to 10 years, and you will not even realize it until the ZATCA points it out to you and say, here you go, there was a calculation error in your return, and therefore we now have up to 10 years. So you're exposing yourself as a zakat payer if you're not paying attention to these calculation errors or mispositioning of a figure. The ZATCA, then the zakat regulation then talks about how the ZATCA gets the extension to 10 years in case of a non-compliance. When we talk about the non-compliance, excuse me, when we talk about the non-compliance, the first and the foremost is the filing declaration, not the filing of declaration after the due date. So in this case, for the year 2023, we just, we have the deadline as the 29th of April, 2024. Even if the zakat return is filed on the 30th of April, 2024, it is considered as a late filing, and therefore the statute of limitation of 5 years goes out of the window. The other example it gives is the declaration being incomplete or filed on a non-standard form. So the ZATCA has prescribed the form that needs to be used for zakat filing purposes. If this form is not used, then it can be considered as non-compliance. If your zakat return is filed in contradiction with the zakat law, zakat provisions, then it will be considered as this, the statute of limitation can be extended from 5 years to 10 years, and failure to pay zakat within the statutory time limit. Now, it is so critical that we stick to the payment of zakat within the statutory time limit, because a lot of times the concept is we're so focused on filing the return that we forget that there is an obligation to settle the zakat as well at the same time. Otherwise, just the submission of the zakat return and not having paid the zakat liability will still be considered as non-filing, which then exposes the zakat payer to the increased statute of limitation from 5 years to 10 years. There are other examples of the non-compliance as well, but due to the time restrictions, we've just stuck to the four on the screen that you see at the moment. The appeal procedures as well have recently been revised. Under the new appeal procedures, items that the zakat payer is not contesting from the additional assessed liability have to be settled with the ZATCA before submission of the objection. And the zakat liability relating to the items that are under contest, under dispute, a minimum of 10 to 25% of that has to be settled with the ZATCA before submission of the objection, and the exact amount payable is to be determined by the ZATCA at the time of submission of the In case the zakat payer decides not to settle the liability, there is also the option of submission of a bank guarantee. What you see on the screen now are the ways that a zakat payer or a taxpayer has to resolve tax controversies. There are certain there is a certain appeal process which Dr. Ahmed will talk about in the next. Essentially, what it is in terms of the appeal, the formal controversy appeal process is that an objection is filed with the ZATCA. It is then escalated to the TVDRC, which is the first level of appeal committees, and then it goes on to the TVDAC, which is the final appeal committee and the final decision maker. During this process, there is an option available to the taxpayer or zakat payer, which is the alternative dispute resolution. Under the ADRC, the taxpayer has, or the zakat payer has, the option to approach the tax authority to negotiate a settlement, which is considered, it's more like an out-of-court settlement. So you discuss with the tax authority, you agree on an amount to pay, you close the cases, and that assessment is then considered as finalized. The next point, which is slightly related to the tax controversy, is the extension of the amnesty. As most of you will be aware that as part of the COVID-19 initiatives, the ZATCA introduced the amnesty initiative, wherein the ZATCA provided relaxation to the taxpayers in terms of the applicability of delay fines and certain penalties. This amnesty initiative has recently been extended up to 30th of June 2024. So that's just an update on the amnesty. I will now hand over to Dr. Ahmed to take us through the rest of the presentation of the session, and then we will go through the Q&A session subject to availability of time. So thank you very much for listening to me, and I look forward to connecting with all of you in the next segment, inshallah. Thank you.
Yeah, thank you so much, Danish, for this updates. Very comprehensive. Thank you for this. If you allow me, I will request remote control so I can access the slides. Let me know if it will work. Yeah, I think it's now.
It should work now, Dr. Ahmed.
Yeah, I think I can use it right now. Okay. Thank you for this. Hello again. Before starting the appeal process, because I believe it's a long journey with the appeal process. I wish if you could have some coffee or tea beside you to enjoy this journey with us. I want to start from filing the declaration. When you file the tax or zakah declaration with ZATCA, and as mentioned by Danish, ZATCA is required within 5 years minimum, maximum 5 years, to review the declaration submitted by your company and come back to you with some queries, some questions before raising the assessment. Once you receive the queries, you have to respond. After responding to these queries, your response is sufficient for ZATCA, they will directly start to raise the assessment. Once the assessment raised by ZATCA, you have 60 days from the date of receiving the assessment to appeal or to object against this assessment. Of course, if the assessment, the issued assessment, if it is came in line with the declaration or with minimum or small liability in which the company is accepted, then you can accept the assessment and to come to the end of the process. However, if ZATCA raised an assessment with big liability in which the company would like to object, then you have to file this objection within 60 days from receiving the assessment. Once you submit the objection, of course, the objection should be submitted within due date, also should be submitted from the authorized person, and there is certain or small amount, percentage of 10% to 25% should be settled along with the submission in order to be accepted from formality perspective. Once the same has been submitted, ZATCA and the review department under ZATCA will review the submission, and they may schedule a meeting or hearing to discuss the arguments provided by you. Once this happens, they will issue a revised assessment, or they may not respond to you till 90 days pass, 90 days from submitting the objection letter. In both, either they came with the revised assessment or they didn't respond to your appeal or to your objection within 90 days from receiving the objection letter, the company or the taxpayer should submit an appeal, this time with the TVD-RC level, which is under GSTC. GSTC is the General Secretariat of Tax Committees, in which we have two committees. One is TVD-RC, which is a review committee, resolving committee, which is level 1, and the other one, which is level 2, TVD-AC, appeal committee. So if you register your case with the TVD-RC within 90 days of the end, within 30 days of the end of 90 days, then you are in the safe side and the appeal should be accepted from formality perspective. Taking in consideration that the one who submitted the appeal is either the authorized person as per the company's article of association or an authorized lawyer who has a law license. Under TVD-RC, we have 3 stages. First stage, which is registration stage, in which you are using the GSTC portal to register your case with TVD-RC. Simply, you have your appeal memo, in which all disputed items are there. Each item is supporting with sufficient arguments and supporting documentations, and you upload the same, and you attach as well a proof of legal representation, which means either article of association showing that who is the authorized person, like the CEO or the chairman, or if you assigned an external lawyer, he should provide the power of attorney along with the law license. This is what we call it registration stage. The second stage is the exchange of memorandum stage. The third one is the hearing, which will be scheduled later on. Before jumping to the second stage, I want to highlight something very important about the legal representation. Sometimes we can see companies are preferring not to assign external lawyer and use one of the lawyers under the company's sponsorship. In such case, there is special license should be issued to authorize this lawyer, because this lawyer is working under the company sponsorship. He doesn't have a law or license to represent the company. He is not a professional license. He doesn't have a professional license. So we should issue a special license for him, from the company to him, to represent the company from legal perspective in this hearing. So after registration, either registration completed successfully and you receive a confirmation from GSTC that the case has been created under number 123, then registration stage has been completed. In certain cases, you are receiving after a few days from registering the case a notification from GSTC saying that there is pending documentation need to be provided within specific timeline. We have carefully to take this in consideration, because if we didn't submit this documentation within the due date, this case can be cancelled as if you didn't register. So once registration of the case has been registered successfully, automatically there is 2 actions inside GSTC. first action that the Secretary of JSTC will forward your appeal memo to ZATCA for their review and comments. They should come back to them with their viewpoints and feedback about your appeal letter. And second action, there is a technical committee within JSTC will review your appeal letter as well. This stage, we call it exchange of memorandum level. This is the second level under TVDRC committee. Once you respond to ZATCA viewpoints, then the case will, the status of the case in the portal will be changed to be under technical study. Under technical study means you responded to, ZATCA responded to your appeal letter, and now they are discussing your appeal and ZATCA feedback together. Once this stage or this level has been done and ended, the committee will schedule a hearing to discuss the disputed items in front of ZATCA and in front of the representative of the company. Of course, this case, once scheduled, there is very clear that the legal representative should be attended only from the company's point of view. So no one who doesn't have power of attorney should be attended. Also, only Saudi nationals should be attended. So unless the company's CEO or the company's chairman, in which his name is clearly mentioned in the article of association, who can represent the case. If he is bilingual, he can speak Arabic, or he can attend with a translator. After the hearing, directly, you may receive minutes of the meeting with the decision, or you may not, and after some time, you will receive the detailed decision issued by the TVDRC, mentioning the TVDRC decision in each item, and also the arguments why they decided in this item like this. If you like the ruling issued by TVDRC, then you will accept. If ZATCA accepted as well, then the case should be closed, and we came to the end of this. However, if the taxpayer only or the payer only accepted the TVDRC decision, while ZATCA didn't accept, then the case will be transferred to the TVDAC. Again, ZATCA or the ZACA payer should transfer the case or register the case with TVDAC within 30 days from receiving the TVDRC ruling, within clearly 30 days. How can I know the start date? So 30 days from the notification, 30 days from either the message you received through the registered mobile number or through the email you received through the registered email address. For any reason, if you lost the access to this email address, or if you lost the access to the registered mobile number, you have quickly to update the mobile number and update the email address registered with JSTC. Otherwise, you will lose the case from formality perspective. When the case started with TVDAC, again, we have either 3 levels or 2 levels. Similar to what we have mentioned at TVDRC stage, you have to register the case with TVDAC. Again, if the information and the documents are sufficient, the case will be registered automatically, number will be provided, no action is required. However, maybe the documents are not sufficient from formality perspective, then they will notify you that XYZ documents should be provided shortly within due date in order to complete the registration process. Once you submit, the process now, the case now registered successfully, then we will move to the second level of exchange of memorandum level. Exchange of memorandum level means the party who registered the case, the GSTC will take the appeal memo and share it with the other party. If ZATCA registered the case, then you as a taxpayer, you will receive ZATCA viewpoints and GSTC will ask you to provide your comments and vice versa. Once the exchange of memorandum ended, the status of the case will shown in the portal as under technical study, in which the technical committee are reviewing the case in order to assess each item and see if each disputed item and see if the supporting documents are sufficient or not. It's worthy to highlight that the technical committee is not the final committee in which they will decide. The final committee is always receiving a draft of a decision or summary of the decision from the technical committee, who propose their understanding of the case, and they are sharing internally their understanding of the case and their understanding of if the case is strong or not of each disputed items. With TVDEC, we have two options here in respect of level 3, which is scheduling the hearing. Some cases, TVDEC will invite both parties, ZATCA and taxpayer, to attend the hearing, and in some other cases, which TVDEC is believing that the case is ready to judge and there is no need to discuss again with the taxpayer representative or with the ZATCA, then they will decide directly and notify you with the same. Once they notify you with the ruling, this ruling should be final and which we came to the end of the process. This is very tricky point, and after the TVDEC decision, you can't again go and appeal again because all appeal stages has been ended by the TVDEC decision, in which if there is any liability and you received an assessment from ZATCA on the basis of the TVDEC ruling, it should be paid immediately once you receive. Otherwise, action will be taken from ZATCA side. I hope this process is clear, and I will jump now to the second process, which is the ADRC process. It's alternative dispute resolution process. Alternative dispute resolution committee is under ZATCA, in which the head of committee is reporting to the governor of ZATCA. Simply, there is a way to resolve your controversy case with ZATCA through this committee. Either you registered your case with the GSTC, in which your case under review by TVDRC or not, or you just received the assessment from ZATCA and you submitted your objection, but they didn't decide yet, you have a right to register your case with the ADRC and submit your request through IRAD system. IRAD is ZATCA system. Once you submit, the ADRC will review your submission and you review the documents provided and either accept or reject. Here, it's worthy to highlight that once you submit the request with ZATCA to admit for this ADRC, your case with GSTC should be freezed because you can't work parallel in both cases. In the past, 1 or 2 years ago, we had to submit an email or submit a request to GSTC to say, please freeze our case number 123 because we are going to submit a request with EDRC. This is what we used to do in the past. Currently, it's system linked. So once you submit the request with EDRC through the ERAT system, automatically your case will be freezed till you finalize your case with EDRC, irrespective of the results. So once you submit the request with EDRC, your case with GSTC will be freezed for some time. EDRC committee will review the submission, and if they accept it, they will invite you for a hearing. They will schedule a hearing to discuss your viewpoints and what is your proposal. What I mean by proposal, that EDRC committee normally has specific form in which they are always asking the tax or ZATCA payer to submit the proposal of payment, in which they are submitting this proposal for ZATCA to accept and close the case. During the hearing of EDRC, they are discussing each disputed items, and they may request additional documentations, or they may believe that the documents provided are sufficient. Then they will come back to you with the decision. If the decision of EDRC accepted by you as a taxpayer, then you have to sign off the form and return it back to them, because there is internal process in which they may need to send the recommendation to the governor to accept the reconciliation or to accept the resolve of this issue, and the governor or his deputy can sign off the final certificate. If they didn't accept, they might reject. Then you will receive a rejection email, and in the same day of receiving such rejection email, your case with GSTC will be activated directly. However, it's worthy to follow up directly with GSTC to make sure that the activation has been done. Maybe system ever delays this, but as per the practice, it should be automatically activated. Here, I want to talk about the benefits of EDRC. EDRC is very good way of appeal. First, it's covering all kind of liability, either ZATCA or tax, either direct tax or indirect tax. And one of the most important benefits of EDRC that it is not considered as precedence for future years, because whatever EDRC will decide will not be like a tax base for them to apply in the future years. So, for example, if you are not happy of ZATCA treatment, but for some reason you want to accept ZATCA decision or EDRC decision just to close the years under dispute, then it is not necessary for the company to accept the same treatment in the future. Also, the EDRC process is more quicker than the GSTC process. The normal appeal process may take from 6 months to 1 or 2 years, but EDRC is very quickly, you can close the case, and it will allow you to apply for EDRC and resolve the ZATCA assessment, resolve the issues while your case is still available with GSTC. They will not put an obligation to withdraw your appeal with GSTC. No, it's only freezed. Then after that, either to accept or not. EDRC also giving you an option to either accept the decision or reject the decision. If you accept, then you finalized the years under dispute and you will settle. If you feel like the ADRC assessed high liability rather than what you should pay, and if you believe that your case is more strong and you will get better results if you continue with GSTC, there is no harm at all to reject the ADRC decision and continue your appeal with GSTC. This topic is very important because although I have mentioned a few minutes ago that at GSTC we have only two stages, which is first level and second level, TVD AC and TVD RC and TVD AC. And I mentioned clearly that TVD AC is the final stage of appeal in which the amount of liability should be final and should be settled with ZATCA once the ruling has been issued and you received the final assessment from ZATCA based on the TVD AC ruling. However, in very rare cases, there is something named appeal reconsideration, in which the taxpayer can use or the payer can use in case any of these 7 conditions has been met. This is very sensitive cases because the possibility to use as new stage of appeal is very minor. So you can't use it as new stage and the new possibility to continue the appeals because it is not a stage, a new stage. Also, this appeal reconsideration will be reviewed by the TVDAC, the same committee who decided the TVDAC ruling. So it's very important to understand these conditions and to use it in the right way. The first one, if the wording of the judgment was contradictory. The second, if after the judgment was rendered, conclusive documents become available and you believe these documents are very important and will support your case. Of course, subject to certain conditions we will discuss in the following 2 slides. Number 3, if the judgment was based on forged documents or religious testimony, or if the judgment was rendered against a person not properly representing in the case, or if the judgment was in absentia, or if the judgment awarded was not what the litigants asked for, or more than what they asked for. And the last one, if there is a fraud case. Simply, if the wording of judgment was contradictory, you have a deadline of 30 days from notifying you about the judgment. Once you received the ruling, you have 30 days. Once you submit the request, it should be specify the part of judgment that has the contradiction, including the reason for this contradiction. If you have 3 items under dispute and the contradiction happened in 1 item, so you can't request for reconsideration for the 3 items. You have to be specified, specification should be provided, which item you are talking about, and you should highlight where is the contradiction if you want to win this case. After the judgment was rendered, conclusive documents become available. Again, the deadline here is 30 days starting from the day the petitioner produced the documents. This is very tricky because It is not a matter of any documents. You have to provide a proof that this document was not there at the time of judgment. And otherwise, they will say, why you didn't submit it in the past? So the company should provide the date they become aware of the conclusive documents. It's very tricky. So again, in order to prove this, it is not an easy. But if you believe in one of these cases, then let's give it a try. If the judgment was based on forged documents, then you have 30 days starting from the day in which the above is proven. If the judgment was rendered against a person not properly represented in the case, the deadline is 30 days, started from the time of notification of the judgment, which should be always through email, through the email registered with GSTC. The request should have a statement from representative, including the reason why the representation is invalid. So you have to prove the case. Number 5, if the judgment was in absentia, this period again for the deadline is 30 days, starting from the time of notification of judgment. The taxpayer should provide the date he became aware of the judgment, because it's linked to the 30 days. The deadline should be counted starting from the date of the taxpayer became aware of the judgment. So you have to provide a proof of this. If the judgment was not what the litigants asked for, or more than what they asked for, then the deadline is 30 days to submit your request. And also the request should state that the judgment was ruled without request or was ruled with more than what the other party requested. If, for example, you submit a request and you found the committee from their side directly give you the right of statute of limitation while the company didn't request, then ZATCA has a right to submit a reconsideration request to say you give them above and beyond what the taxpayer requested. Finally, if there was a fraud case, then 30 days from you became aware of the fraud. But again, if the deadline is 30 days of the date in which you are aware of the fraud, then you have to prove when you became aware of the fraud and what is the impact of this fraud. We will jump quickly because we are running late of time. We have some amendments of the current Zakat Bylaw. So I will go quickly to give some time to the question and answer, but I promise I will not leave till we cover all questions will be raised by you. I hope this is fair with you and fine with you. We will start with some new amendments to the current Zakat Bylaw issued and effective from the financial year starting after the date of issuance. It's issued in April 2023. These amendments provide new Zakat deductible items and the clarification on the amount to be paid on appeal. It's already highlighted a few minutes ago by Danish, from 10 to 25% of the liability on the disputed items. Other minor amendments were issued as well to the Zakat regulation for financing activities. So I want to start with Article 5 and 6 of the Zakat regulation, in which they started to allow the new Zakat deductible items for employer relating to employees' housing with certain conditions. First, employee houses owned by a Zakat payer can be deducted from the Zakat base. Also, housing loan provided to the employees under the employees EHOB, which is EHOB is very important program subject to certain conditions. First, the financial loans is made through an interest-free loan. So if there is a loan has been incurred by the employer, it will be challenged here. Also, the price of the housing unit borne by the employee doesn't exceed its actual cost to the Zakat payer. This means that while they are reviewing the Zakat payer and checking the value he claimed as a deduction, they will ask for a proof of the cost of the housing borne by the employee to compare both together. Also, financing costs incurred by the employer on behalf of the employee under EHOB is an allowable deductible cost for Zakat purpose. EHOB is stand for Employee Housing Ownership Program. Another article, Article 8 of the Zakat Bylaw, has some changes. It's related to non-trading investments in stock and bonds, which is traded as capital by the issuer for Zakat purpose. Traded as capital, if you remember what Danish mentioned about the internal source of fund versus the external source of fund, if we mention that it's treated as capital, means it will be treated as internal source of fund. For Zakat purpose, it's deductible from Zakat base for the investor, regardless of its classification in the issuer financial statements. Also, Article 25 of the Zakat Bylaw has been amended to provide clarity on the amount to be paid. As we mentioned, it's either 10% to 20%, and ZATCA should provide a clarity on specific percentage need to be settled. And the current practice, once you are trying to submit your appeal, you will not be able to submit in Iraq because they will ask you to share a proof of payment because it's already linked. So they will tell you this amount represents the amount which is not disputed with ZATCA, so you have to settle the Zakat or tax on it, in addition to either 10% up to 25% from the liability on the disputed items as well. Once you pay it, then automatically the system will accept to submit your appeal. So it is not a negotiable item, or it is not something you can submit your objection without being paid such amount. Also, the Zakat regulation for financing activities were amended to expand the regulation to cover the fund that involved directly or indirectly in financing activities. These are some practices made by ZATCA. In April 2023, ZATCA published a document including ZATCA view on the Zakat treatment of some disputed items, and we are highlighting here 2 points. If you pay dividend of the current year profit and it's exceeding the opening balance of retained earning, it still can be deducted from Zakat base, provided that Zakat is not computed based on adjusted profit, which should be the minimum Zakat base. Also, the fund should be paid out to the beneficiaries, and supporting documentation are available. Of course, it's very important to pay this fund before completion of Hijri years. You know, there is, if your fiscal year ending 31 December, There might be like 10 days difference between Hijri year and Gregorian year, which should be considered. Also, for payment out of provision for Zakah, they highlighted that payments out of provision are allowed to be deducted from adjusted profit of the company if the company pays Zakah on adjusted profit for the year, which is the minimum Zakah base. These some Zakah rules for investment funds. I know I'm running out of time, Danish, but inshallah I will try to cover this in the coming 5 minutes. So for investment funds in general are not subject to Zakah. However, there is some requirements that the investment fund are required to register with ZATCA. Also, the manager of the investment fund should file an information return within 120 days of the year end. This return should be supported with the financial statements and the record of investment fund transactions with related parties, in addition to any other data that ZATCA may request from the fund. In respect of the treatment of the unit holders, the unit holder may deduct the value of its investment in the investment fund from its Zakah base, subject to some conditions. First, the investment in fund is for non-trading purpose, like real estate, for example. And the calculation of Zakah should be done on the fund financial statements, and the related part of Zakah should be settled with ZATCA. If the unit holder is hold 20% of the fund, then the calculation of the fund should be calculated, and 20% of this Zakah should be settled on behalf of the unit holder. The minimum Zakah would be equal to the unit holder share in the net adjusted profit of the fund. And finally, if the fund owned by one unit holder, then consolidated Zakah calculation can be done. I think this is the last one. It's very important. It's rules for exemption. Rules for exempting Zakah payers owned by endowment funds, awqaf. We call it in Arabic awqaf. In January 2023, ZATCA issued some rules for exempting entities owned by endowment funds from Zakah. Zakah payers can opt to apply the rules to the fiscal years on which the current Zakat Bylaw is applicable, and normally these rules are applicable to fiscal years starting on or after January 1st, 2023. The rules are applicable to Zakah payers who are fully owned directly or indirectly by the endowment fund, since the endowment fund established and registered in KSA. The Zakah payers are not to be subject to Zakah if some conditions are met. First, the endowment document states that all earning of the endowment will be spent for public welfare purposes. And if there is no specific allocation, or if there is a specific allocation, it should not be exceed 10% of the endowment fund's income. Also, the Zakah payers on whom the rules are applicable should submit an annual application for Zakah exemption. And this application will be reviewed on a yearly basis by ZATCA to assess if the exemption are applied or not. By this, I came to the end of this session, and thank you for listening, and I'm happy to receive your questions. Over to you, Salman.
Thank you so much, Dr. Ahmed, as well as Danish. for your valuable knowledge transfer to our members of the institute. Definitely, it was really a wonderful session with the in-depth, which basically the depth you test on the both of you on the ownership profile, components of Zakat base, sourcing of funding, and very much important things which you touched upon is the importance of MR 2216 and controversies, appeals. Really, it means a lot for all of our members of the institute. So now, if anyone has question, he can raise his hand, and then both of our panelists can answer your questions. So far, I received two questions in writing, but you can also raise your hand so that the relevant questions can be answered. Danish, if you can see, or Doctor, if you can see the questions on the screen of Q&A, you can directly answer. Otherwise, I can read for you. It's up to you.
No, I'm looking at the
should I read?
question. I'm looking at the question. The first one from M. Azim. Am I right to say that external sources are liabilities? And if that is the case, how A plus C, B plus C minus D equal to Zakat-based fund? I'm not entirely sure that I understand the question. Maybe if you can elaborate a little bit on this, Azim.
So anyone can raise his hand, and then I'll open up the mic for them. Okay, Doctor, I allowed you to talk, Dr. Saifuddin. Yeah, your mic is open to talk. Okay, you are still okay. You can speak now, Dr. Saifuddin. Okay. Meanwhile, Obed, you are also allowed to talk.
Thank you very much. I have a quick question regarding this advance that we receive from the customer, which is added in the Zakat base. So I just want to have a clarity on one thing. If these advances are received against non-revenue services, like we receive in a logistic company, we receive advances from customer for the duty payments. So they make the payment to us, and we make the payment on their behalf. Now, because of the time period, some of the advances are left open at the end of the year. So do we need to add this in our base, Zakat base, or should we keep this as non-service item and should not consider or add it in the Zakat base? That first part of the question. The second part is also related to this, which is in case, because Zakat is not subject to penalty. So can a company take a stand that we are considering this as a non-revenue service and will not add in the Zakat base? And later on, if Zakat identify and they say that it should, there's a difference in opinion, and they said it should be added, and they apply the penalty, or not the penalty, they include this in the Zakat base and recalculate the Zakat. So it will be, our liability will increase and we'll have to pay that thing. But at that time, there will not be any penalty. And with this, will this also be considered as a extension in the Zakat assessment as 10 year or 5 years, something like this? Thank you very much.
Thank you, Sayyid. I think I'll take the first part and then I'll go on to the second part. The first is, it is the classification of the liability in your financial statements that determines how the treatment of the liability will be from a Zakat perspective, irrespective of whether this is to be considered as a direct revenue generating liability or a non-direct revenue generating liability. So long as it is classified as advances from customers, the ZATCA is likely to add these to the Zakat base on the assumption that, not the assumption actually, as per the Zakat implementing regulations. The lower of the opening and closing balances will be added to the Zakat base. Now, the second part of the question in terms of whether they should not be added to the Zakat base, and then the ZATCA might do that in the future, and if there is any liability that the company can then settle it in the future, you can certainly do that because there is no delay fine on the Zakat liability. However, there is a possibility that ZATCA can actually use that to extend the statute of limitation. Personally, myself, I have witnessed this in the past, that such aggressive positions have been taken by the zakat payers, and the ZATCA has then used that aggressive position as a ground for them to extend the statute of limitation, and then it goes on to the appeal committees for them to decide. But eventually, it is a liability that should be added to the zakat base, and the zakat should be settled on it. What is more important to also consider is the argument about not having the delay fine implication on the zakat liability. That, I think, is just a matter of time, because we've recently received the draft zakat regulations as well as the regulations, the procedure. Although they are not part of the regulations yet, they have not been officially issued. However, there is a discussion the draft regulations include a provision whereby there will be a delay penalty on the zakat as well. So just to give you all a heads up, zakat liability at the time of this discussion right now, there is no delay fine on the zakat. However, there is a mechanism being introduced by the ZATCA to actually act as a measure to cut down on these aggressive zakat positions that a lot of zakat payers have taken in the past. I hope that answers the question.
Thank you very much.
Okay, Dr. Sab, if you can speak, otherwise we have some writing questions. Okay, I think Azim has also elaborated in the second question if it can be answered, otherwise we can move to the next.
Let's have a look. It says it should be adjusted profit plus internal sources minus external sources. No, it's not. It's not plus internal sources and minus external sources. Essentially, what it is the internal sources plus the external sources minus the zakat deductible assets. So whatever the balance is of that, which is basically B plus C minus D, whatever the difference is, that is considered as your zakat base. And then you have the adjusted profit, which is also considered as part of the formula, which is A, that is the adjusted profit. That is how you look at the zakat calculation. And I hope that answers the question.
Okay, the Asif is saying need a bit clarity on the carry forward of losses, if it can be adjusted.
Carry forward of losses can certainly be claimed as a deduction from the zakat base, which is again, carry forward of losses are actually part of the equity in the presentation on the financial statements. So you would either have your carried forward losses, which are your accumulated losses, or you would have retained earnings. So in case of retained earnings, these are positive additions to the zakat base, whereas your accumulated losses are considered as zakat deductible. So yes, you can adjust them while filing your zakat return.
Okay, thank you, Danish. The next one is Amir is asking difference between zakat. I think he just copied some Arabic Nizami or Taqdiri something. Yes, yeah, I'm not sure what he's asking.
I think he's asking about the arbitrary assessment, the difference between the arbitrary assessment and the normal assessment, which is Nizami as per the regulation, which is a regulated assessment maybe. So if you allow me to take this question, Danish, normally the normal assessment, we have two kinds of assessment as per the regulation, which is, you can name it Nizami as you mentioned. First one, either ZATCA visit the company and started to do some audit to the books of accounts and then come back to you with the assessment. This is regulated assessment. Another one, without any visits, they might send only queries to get some clarity about information and accounts already provided in the financial statement. Once done, they will raise an assessment as well. A arbitrary assessment can be done, I think, in case you fail to submit the declaration on time, and also if they believe that a non-resident entity is conducting activity inside the kingdom and there is a PE created a PE, permanent establishment, inside Saudi Arabia, then they might raise an arbitrary assessment to estimate the liability as a result of such action. I hope this is clear with you. Thank you.
Okay, the next one is revaluation of land or non-current assets treatment, about unrealized gains subject to zakat or not.
Dr. Ahmed, do you want to take this one?
Yeah, I will do. If I understand your question correctly, you are talking about the unrealized gain or loss from investments in land. So normally, this account, if they claim the deduction of land, it should be taken in consideration and should be subject to zakat. However, if they disallow the land from zakat base, then they don't have the right to add it to zakat base. The purpose of this is that the actual market value of the land is the sum of the two values, the value of land and the value of unrealized gain. So if you want to add the unrealized gain, then you as a zakat payer should get benefit from claiming the asset from the zakat base. This is the purpose of this. However, as a direct answer to your questions, it's subject to zakat in case this land is being allowed as a deduction from zakat base, and if it is not, then they should not add it to zakat base.
Yes, Ubaid, again, I think you have a question or?
Yes,
not?
I have a question. So regarding this principal and agent, which is considered as a P relation, establishment of permanent temporary establishment, creation of the temporary establishment in Saudi or P. So if we are deducting the withholding tax while making a payment to a non-resident of the company, then we don't have to apply for a P. That's the basic understanding that I have. However, if we register them, then they get some sort of benefit for that thing. But if they are not willing to register themselves as a P in Saudi, then we can continue deducting the withholding tax. And in that case, we as a registered company in Saudi will not be responsible for any other consequences by the ZATCA because the company or the principal is not registering himself as a P. Is that a clear understanding?
Let me, Danish, want me to answer?
Yeah, please go ahead. Sure.
Okay. See, Mr. Abid, we need to highlight something. If there is a BE in which a non-resident created as a result of conducting business inside Saudi Arabia, it means he is doing business inside Saudi Arabia without registration and without registering his file and getting file ZATCA file in Saudi Arabia. So deducting withholding tax on the overseas payments made from a resident to non-resident, it doesn't mean that the BE will not be created. Withholding tax you deducted shall be considered as tax credit for this non-resident entity, and the maximum benefit you can get is to use this withholding tax to reduce the liability will be arised as a result of the arbitrary assessment. But you can't use this withholding tax as a reason why this non-resident didn't register inside Saudi Arabia. I'm not sure if I answered you in this clearly, or you still
no, I think you have clarified that thing. So principally what you are saying is that if the answer that I understood from your answer is that if despite of deducting the withholding tax, the company has to be registered as a P in Saudi. But is this liability raised with us to get them registered in Saudi, or our liability is limited to with paying a withholding tax to the government, or also we also have to register them as being an agent of them in Saudi? So is it our responsibility to register them?
See, your responsibility to choose your suppliers, to choose the right supplier who is complying with the regulations, because you are the party who will be audited by ZATCA. So if ZATCA reviewing your files and they monitor that you engaged with the foreign supplier, and the foreign supplier in which some of the criteria are met, in which this supplier should create a BE, and they didn't create the BE, you know who will receive the assessment? You know who will receive the arbitrary assessment? You will receive. And your company will be jointly responsible to settle this liability. So I'm not sure, Danish, if you agree with my view or not, but I believe this is the practice, and this is the right practice, because of you, this foreign company became working inside Saudi Arabia.
Understood.
So the responsibility is jointly between both of you. But if ZATCA is enabled to catch the foreign supplier, then they will address the liability of the assessment to your respective company.
And we have practical examples of that happening as well. We've seen that in practice.
Yeah, absolutely right. Yes.
Okay. Dr. Saab, the last question from your side. Okay, I think he may not be able to speak. Okay. Okay, so Danish, if you can stop sharing the screen, and we can allow everyone, if you can turn on your cameras, and we can have a snapshot of the event. Everyone, if you want to. Okay, I think, let me see the view. Okay, I'll make like this. Okay, screen. Okay, the last thing is, yeah, I have taken the snapshot. The last thing is, if anyone need the certificate of the event, earlier we had a practice to provide the certificate directly on the email after the event, or week after the event, but now this practice we are going to stop. So all the members who are joining, normally they are receiving their certificates directly, and their CPD, I can say, record is automatically being updated. And whosoever want to get the certificate, I have already mentioned in the chat, events@ifa.org.uk. You can send email and get your certificates. And again, once more, thank you so much, Dr. Ahmed, as well as Danish, for your valuable contribution and loads of knowledge and insight on Zakat and tax. We really thankful to you, both of you, for arranging this webinar. And thank you so much, everyone, for joining, and enjoy your the starting week, I can say, who are in Saudi Arabia for tomorrow. Thank you. Thank you so much.
Thank you very much, everyone. Thank you. It was a pleasure. Thank you.
Assalamu alaikum.
Welcome.
Yes,